Hey everyone, welcome back to Corporate Decoder. Today we're cracking open some interesting reports, two funds actually, that are managed by Starboard Investment Trust. It's like they're trying to impress someone, but honestly it just makes the whole process more confusing than it needs to be. And we're diving into the financial details of the Matisse Discounted Bond CEF strategy, and 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 the Matisse Discounted Closed-End Fund strategy. These aren't your average companies, they're investment funds that specialize in buying other funds at a discount. We will find out whether they perform well and are worth your time, or just some funds doing whatever before we start. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. These funds operate under something called the Investment Company Act, a set of rules designed to protect investors. It's all about making sure these funds are transparent about what they own and how they operate. We're looking at their annual reports, which give us a peek into their performance over the past year, ending in March of 2025. These reports offer important information. It talks about some changes to the funds that occurred during the year. So let's see what those are and what the numbers tell us. First up, how well did these funds actually do with our hypothetical investment? For the Matisse Discounted Bond CEF strategy, ticker MDFIX, a $10,000 investment cost you $115, which is 1.1% of your investment. Then for the Matisse Discounted Closed-End Fund strategy, ticker MDCX, a $10,000 investment cost you $161, which is 1.53% of your investment. For reference, these are costs that they charge for managing the fund and other expenses. This is something to keep in mind when you are investing in one of these, as expenses matter. How did the funds perform? The Matisse Discounted Bond CEF strategy had a return of 8.51% for the year. It outperformed a common bond index but tracks similar closed-end funds. This is okay, but still we need to look into more factors to have a better overview. So meanwhile, the Matisse Discounted beating the S&P 500, but again, it landed somewhere in the middle when compared to other closed-end fund indexes. Since their creation, if you invested $10,000 in the Matisse Discounted Bond CEF strategy back in April 2020, you would have $15,012. For reference, you would have made less if you simply bought into the Bloomberg US Aggregate Bond Index, but you would have made around the same amount if you had invested in FT Taxable Fixed Income CEF Index. If you invested $10,000 since March 2015 in the Matisse Discounted Closed-End Fund strategy, it would be 22,800 index, be actually a lot less than if you simply bought into the S&P 500 index. The average annual returns can give us a more clear picture. The Matisse Discounted Bond CEF strategy gained 8.51% in the past year, with an average 8.61% return since inception. The Matisse Discounted Closed Discountee are these funds invested in the tint. 46% in the last year and 8.46% annually since its creation. We can compare that with other indexes and decide whether those numbers are something we like or not. As of March of 2025, the Matisse Discounted Bond CEF strategy had about $54.5 million in assets, and the Matisse Discounted Closed-End Fund strategy had about $51.4 million in assets. This is not that much, so we need to be more careful. They hold 37 and 38 investments respectively. It also tells us the advisory fee that was paid, which is important in our assessment. Looking at what these funds invested in, we can see for both the biggest holding is in short-term investment. This refers to liquid low-risk investments such as bonds and treasury bills. For the Matisse Discounted Bond CEF strategy fund, it represents 31.6% of the asset. For the Matisse Discounted Closed-End Fund strategy fund, it represents 9.3% of the asset. For the Matisse Discounted Bond CEF strategy fund, it represents 9.3% of the assets. For the Matisse Discounted Closed-End Fund strategy fund, it represents 9.3% of the assets. Alright, this is something interesting. The advisory fee, what the fund charges to manage your money, changed during the year. For both funds, the advisory fee decreased, which is good news for investors. Also, they removed their expense limitation, meaning there is no upper limit of what the fund can charge in expenses. Beyond the numbers, there are other important details to look at. The fund has a code of ethics for its executives. They've also identified who on their board is considered a financial expert, someone with a deep understanding of accounting and finance. This expert is Mr. James H. Speed Jr., and he is considered independent, which means he is not affiliated with the fund, and this offers some oversight for investors. The report goes into detail about what they paid their accountants. This includes fees for the audit and preparing tax returns, as well as the fees for tax compliance, tax advice, and tax planning. One thing to note, they pre-approve the fees, which is a good thing because it offers more transparency. It's essential to ensure that the audit committee pre-approves these services. It means better oversight on how the fund spends money. The fund has a separately designated standing audit committee established. The fund's audit committee members are James H. Speed Jr., J. Buckley Strandberg, and Theo H. Pitt Jr. As we said earlier, it is important to have this committee and for it to be independent. It's also worth noting the risks involved, including general market risks, investment risks from the funds and the securities that it buys into. Also, cybersecurity risks. Finally, the President and Principal Executive Officer and the Treasurer, Principal Accounting Officer, and Principal Financial Officer have concluded that the registrant's disclosure controls and procedures are effective. This is an important declaration and essentially means the people at the top of the company are confident that it reports their financials correctly. So what's the bottom line? The report paints a picture of funds trying to outsmart the market by picking value stocks and discounted funds, but with mixed results. Expense ratio is higher than its category, but the fund has a track record of outperforming its benchmark, so this might be something to look at further. The investment strategy involves significant risks, but nothing out of the ordinary. The funds also try to be more transparent by being open and giving data on fees that they paid. The advisory fee decreased, but there is also no limit for the expenses, so we have to keep an eye out on that. Overall, these funds present an intriguing case for investors who understand the risks involved. Their performance numbers are decent and the fund structure is decent. What do you think about Starboard Investment Trust's management of these funds? Are they on the right track, or is it time for a change in strategy? Share your opinions in the comments below. If you found this breakdown useful, be sure to hit that like button and subscribe for more content like this. And don't forget, our Discord community is waiting for you. Link in the description. Thanks for watching, and I'll catch you in the next video.